Silicon Valley Bank is gone under, and so has Signature Bank. And now Credit Suisse is saying that they are having trouble and just borrowed $54 billion from the Fed in Switzerland. What is going on with banking? We're about to find out in part one of a two-part series with CEO of Bank 21, Tyler Knott. Check out the episode right now. Hello and welcome to another edition of the Mistake-Free Real Estate Podcast. I'm your host, Marck. Today I'm joined by a good friend of mine and banker. Banking is the hot topic of the day today, so I'm proud to be joined by the CEO of Bank 21 here in local Blue Springs, Missouri, Tyler Knott. Welcome to the show.
Thank you very much, Mark.
Tyler, not since 2008, in my recollection, has a bank failed. There may have been a few minor ones here and there that were insignificant, but today we're faced with both SVB and Signature Bank, and now we hear this morning that Credit Suisse is on the rocks. What is happening in the banking world?
I think it's key to start with what is a bank failure and types of bank failures. And really there's two big types. There's an asset failure and there's a liquidity failure. And what we saw previously in 2008 are asset failures. And that's where the assets of the bank, the loans, mortgage-backed securities, they start decreasing in value and the bank gets upside down. And so there's a failure on the asset side. So it's the management is at fault for investing in assets that were higher risk. Mm-hmm. They didn't mitigate that risk properly. Liquidity failure is a little bit different in that it's the access to cash. So if you have what is known as a run on the bank, or a large portion of your depositors wanting to pull their money out of the bank, then you've got to be able to liquidate your assets or pull from lines of credit very quickly in order to pay those depositors. Because on a bank balance sheet, depositors' money is a bank's liabilities, and assets are bonds or loans. And so in SVB's case, they had a highly fickle, concentrated deposit base of people that in businesses that had a lot of money over the FDIC limit. And so there was a lot of venture capitalists and tech money. And when a banker sees that you've got these high concentrations of deposits in businesses like that, you have to think, well, they're probably not going to leave their money in zero interest bearing checking accounts for that long. Yeah. So if I'm going to then invest that money, I need to go really short. I need to keep it in Fed funds, which is basically Fed funds operates kind of like a bank's checking account. So highly liquid. Or you keep it in much shorter treasuries. So 30-day, 60-day treasuries versus what they were buying. They were buying 10-year treasuries, 5-year treasuries, things like that.
Which when the interest rate goes up, those go down in value, correct?
That's correct, because when they buy those, it's at a set interest rate. And so when interest rates go up, in order for someone to want to buy that lower interest rate bond, you've got to sell it at a discount. And so those, then you start seeing losses. And on a bank's balance sheet, you'll see unrealized loss. And that means that they haven't sold it yet. It's an unrealized loss. If they carried the bond to term, there would be no loss. They would just earn that smaller interest rate.
So for someone, on regular Main Street terms, if someone owns a house mm-hmm. and it goes down in value for whatever reason, you could have an unrealized loss if you don't sell that house.
Right.
But then let's say that it was going to go down 1 year and then come back up in the next 2 or 3 years. Someone that held on for 2 or 3 years would be fine.
Right.
But someone forced to sell at this point would sell for a loss. You're saying in the similar way, their long-term securities had gone down and they were forced to sell to provide the liquidity to the market.
For those depositors that wanted to withdraw their money. And you're absolutely right. I think everyone's experienced that. If you bought a house in 2006, mm-hmm. say, and you held on to that house till last year or the year before.
Thrilled.
You did that curve.
Yeah.
You went through that curve and you got to see that, hey, I bought it for 200 in 2006. It went down to 150. But now all of a sudden when I sold it last year, it's up to 250, 300. So you saw that unrealized loss, but then you realized a gain because you were able to hang on to it longer. Now, in that same example, let's say that in 2008 you decide to go back to college, or you need the money for health reasons or something like that, and you're forced to sell that house. You are realizing that loss. You bought it at 200, and now you're selling it at 150 because you're selling it in 2010. So you needed that liquidity. In the same vein, these banks, SVB, they had these large depositors, these tech companies, these venture capitalists, and a small portion of them needed their money. And then they sold those bonds at a loss. And I think it was a $1 billion loss that they realized. Well, then what happened is some venture capitalists, some other depositors got on Twitter and started talking about this and saying, I think you should take your money out. And so then it caused a run on the bank because they had all these people that had deposits greater than that FDIC limit, which gave them real pause. If there's a failure here, will I be made whole? And so they ended up causing a bank run, and the bank failed pretty quickly. The FDIC came in before the close of business.
So talk about the failure. So when you say it fails, is a failure at that point? It was a liquidity failure. Is that the banker saying, sorry, you cannot withdraw funds right now? Is that when it comes deemed a failure? If someone came in and said, I want money, and they said, no, we don't have.
When the FDIC comes in and takes over and closes down business.
What forces the FDIC to do that?
Well, in this particular case, they got notice. Whenever a bank issues stock, the FDIC gets notice of that. And so you're required to. And so they, SVB, decided that they were going to try to issue stock to cover these deposit outflows. So raise capital, raise cash, and the FDIC came in and said, no, we need to stop this, take over, mitigate any more losses, because what could happen is that their whole bond portfolio, if they sold all of that and realized all the losses, then they could be negative capitalized, and then the FDIC is taking a bigger hit. If they go in and stop it sooner, they can preserve those assets. It's in that house example. If we're talking about that $200,000 house that you bought in 2006, but now 2010, you've got some sort of crisis and you need help. Well, now mom and dad are coming in and they're saying, hold on, don't sell the house. We've seen you sell all your furniture at a loss, but don't sell the house. So that's what they did. They protected what was left of the bank, and that was the rest of the bond portfolio and the assets of the bank.
And FDIC has that much power because they back and guarantee the money that's in the bank. Is that right?
That's correct. Yeah, every bank is subject to the whims of the FDIC. And they can, at any time, if the FDIC feels that a bank is insecure or being poorly managed, then they will come in and fail that bank, is how it's phrased in the banking world. So we undergo rigorous examination standards by the state and FDIC, and if you're a national bank, it's the OCC and the FDIC, and some Fed member banks they will be examined by the Fed, but they all work in conjunction. And what it is every 18 months, and for these larger banks, they have their prudential regulators on site all the time, every day, and so they see what's going on. For a small community bank like us, we're getting examined every 18 months it alternates the state and then the FDIC and then the state again, and it just keeps alternating.
So the Fed is not in your building once every 3 years.
No, we're getting examined every 18 months, and then.
But I thought you said state and then Fed and
state,
then.
But they all communicate. So the state reports to the FDIC, the FDIC reports to the state, And so in this particular case, SVB, it's the FDIC signals to the state, and I can't quite remember what the state regulator is for banks in California, but that was the regulator that came in and actually failed the bank.
So clearly a run on the bank at SVB, largely from what I'm hearing you say, just an uneasiness of whether their deposits above $250,000 would be covered. So clearly now we've seen the FDIC came in and said, hey, don't worry about it. We're going to cover everything above that number anyway. Was that the right move, or is that going to cost taxpayers money? Is that the government saying we're going to kick money in now, and is that government, public dollars that's going to correct that?
It's a great question. The likelihood of taxpayers being charged for this are very low. The only way that I think taxpayers could be charged is indirectly. So what they're going to do is any expense the FDIC incurs through these bank failures, it usually trickles down to other banks. So we pay FDIC assessments all the time, and so they can raise and lower those assessments based on the pool of money that they have to handle bank failures. And so when you go for years without bank failures, that pool gets bigger and bigger. Mm-hmm. So they've got a good reserve that they can use to step in and take care of people in this. And I think it was a good decision. They've done a couple things in response to these bank failures. They've said that we're going to cover everyone, even over the FDIC limit of $250,000. And they've also said that they're going to, the Federal Reserve is going to start this new lending program through similar to the discount window, where they will offer banks with these massive bond portfolios with unrealized losses the ability to borrow against the par
like collateral.
Value.
Okay.
So using that house example, it's basically that bank coming in, the Federal Reserve coming in and saying, we're going to lend the value of the house back when you bought it.
Yep.
The par value.
Not at 100%, but at some kind of 50% LTV kind of thing to give them some liquidity.
I'm not sure the LTV requirements, but I think it might be pretty close to the full value.
Oh wow!
Because banks are already very regulated when it comes to what types of assets we can buy. We can buy and own mortgage-backed securities, treasuries, municipal securities, and so it's already a very safe class of assets. So even if the Federal Reserve had to take those back, if the bank ended up failing after that loan, as long as they held on to them, those would be perfectly safe assets.
Well, I've heard them referred to before as a zero risk loan. And that's why I'm like, anytime I hear zero risk, you have to raise the red flag and say, where's the catch?
Yeah.
So how is it a zero risk loan if then these things are getting defaulted on?
Sure. Well, the loans themselves aren't getting defaulted on. The bonds themselves, I should say, aren't getting defaulted on. It's a U.S. Treasury is backed by the full faith and credit of the United States government, and always has been. And but
the value can fluctuate.
The value can fluctuate, and so that's just the market of who wants to buy a bond. If I offered you a 1% bond today, you'd say, I'll pay you a lot less than what you bought it for 2 years ago, because I can do a lot better for 1%. I could get a 4% bond today. So it's but the credit of the bonds is there's zero risk there.
Okay, I want to go into depth on a particular topic. You had mentioned that there were some investors in SVB, clearly, that had massive holdings. Mm-hmm. In general, what percentage of bank customers, what percentage of the bank's deposits is from just your mom and pop that might have a couple $1,000 or less than $10,000 in a checking account at any given time, as opposed, and I think, does that differ greatly in like California then, and just like middle of Missouri? But what percentage is like these massive deposits of people that, some farmer that may be super wealthy and just have a bunch of money in your bank versus, a teenager or someone that's just got a regular, paycheck to paycheck checking account kind of thing?
Yeah, no, it's a great question. For a community bank like us, we have a well-diversified depositor base, and most of our deposits, I'd say 99% of them are below that 250 limit. We've got a handful of people that are above that, and it's in a community bank. It's very that's a classical community bank. You've got a diversification of different businesses that people are involved in. We've got ag customers, we've got commercial customers, we've got people that own lawn care businesses, and people that are flipping houses, and people that are building houses, and people that own software companies. It's a big diversified mix of types of customers. SVB, they had a very niche type of bank, and so it was a lot of venture capitalists, and it was a lot of tech businesses. So if you've heard, Roku was a big deposit customer of theirs, and so when you're weighted in such a concentration, then you have to manage that risk, and there's a risk that there's going to be deposit outflow, and so when you're trying to manage that risk, you take those deposits, the bank's liabilities, and you have to invest them in assets. You can't just keep cash, because as a bank, you need to put it in Fed funds, that checking account. Well, that's going to earn a rate of return. And so if they would have kept it in Fed funds or done some short-term bonds, the losses wouldn't have been as great. And so you really need to look at what your bank is composed of to properly manage it. And so it's not to say that if you look at really any bank, you can look at what the deposit base is, what your asset base is, and you can see what you need to do to manage that liquidity risk.
So do you believe that SVB, do you think it was greed for them trying to just go after like the maximum amount of return they could get on their capital? Or was it mismanagement and non-diversification of funds?
I think it was trying to maximize the spread. So Fed funds is going to earn a lot less than a longer-term bond, but you've got a lot of liquidity risk, and the liquidity risk doesn't exist unless rates go up, and so that interest rates risk that they didn't anticipate killed them.
Yeah. So Tyler, what are the big lessons here for our investor base? First of all, we'll get to the one big lesson, but I also want to ask on behalf of some of my investors, is there any risk whatsoever for our local banks here in Kansas City? Is there any risk that you see, the ripple effect that this may have in other more regional banks?
I do not see any risk in regional or even community banks in our area. We're lucky enough to be in a region that is very diversified with different types of businesses. Whereas Silicon Valley, you've got a lot of tech sectors. New York, you've got a lot of Bitcoin and tech up over there. And then we didn't even touch on Credit Suisse, which is a little bit different issue because they've got a lot of the flux that you're seeing over there, and they took a $54 billion line of credit today to shore up some liquidity concerns. A lot of that's reputation risk. So they were just convicted of some money laundering issues. They've had a lot of bad press. They've gone through a kind of a string of CEOs lately. And so there's a lot of, when you're in this kind of panic environment, there's a lot of people that look to not only, is the bank able to cover liquidity concerns, but is the bank being properly managed? And are there other things that we aren't seeing yet? And so when that causes stock prices to drop, then that can also cause a liquidity concern for the bank, because if they need to issue new stock, to raise capital, they're issuing it at pennies on the dollar of where they were, say, a month ago. So
literally a bank's reputation, I mean, I guess like any business, but significantly important is a bank's reputation on the market.
Exactly. A bank's reputation is key. It's really key in any industry. But the reputation for proper management is 100% key. And proper management means diversification. You've got to have a good diversified depositor base. You have to have a good diversified asset base as well.
Yeah, I think that's the big takeaway. You were mentioning an analogy earlier about kind of a run on the bank that is largely panic based, in the same way you had kind of referenced kind of the herd trying to leave in if someone yells fire.
Right. You're exactly right. I mean, it's right now you're kind of in that environment where someone's yelled fire and there's a panic, and if everyone would just calm down and slowly move towards the exits, no one's going to get trampled to death. And so I think that's what everyone needs to keep in mind, is that this too shall pass, and that keep your cool heads will prevail. And remember that we have the best, strongest banking system in the world. Our Federal Reserve and FDIC were capable of coming in and making all the depositors whole, even over that $250,000 limit.
Who's going to come in and buy SVB and Signature? What does that look like? Is it another bank?
Yeah, it's hard to tell right now, but I would make a very large bet that it would be another bank, and a very structurally sound bank, probably one of the big banks that are too big to fail. They've got the management expertise to come in, and then they also have the capital to shore up any issues there.
So like a Blackstone coming in, like a massive private equity, that wouldn't be an option?
I would not see that. The structure that you have to have in place to properly manage a bank is not something that you can put together overnight.
Yeah. So the big overarching ripple effect that could go through the rest of the world, I see some sense of panic of how this is going to come through and impact the markets in Asia and Europe and the UK. Is that largely just a mentality and a panic-related fear? There are really no financial dominoes that are literally just waiting to fall. It's really, if everyone would just calm, you feel secure in what is coming forward?
That's exactly right. And that's the difference between the liquidity failure and an asset failure. Right now, assets are doing great. The housing market's great. Bonds are great. No governments are looking at defaulting on their debt. There aren't any issues with any of the bank's holdings. You see that that loss rates from banks are way down, foreclosures are way down. You just aren't seeing the asset issues that you saw in 2008, where those were true asset crises.
So I heard you talk earlier about Bank 21 and your reference to your bank, about how you had agriculture and commercial and a little bit of tech and real estate and new construction. You seem very well diversified. Is that the takeaway here, that if a bank is well diversified, then there's strength?
That's right. So on the asset side, diversification and proper underwriting are key. When we're looking at a loan, we're looking at cash flow, collateral, character, all of the classical aspects to bank underwriting. And then on bond side, we really only buy bonds when we're trying to match those with public deposits. So statutorily, when a public entity deposits money in the bank, we have to match that with a bond by statute. And so we'll buy a bond to match, say, a community that opens up a CD, or a school district that opens up a CD in the bank. And on the liability side, diversification is key, in that a large swath of depositors representing various segments of the community are good. And that means that you're representing the community really well. So our depositors are also people that we're lending to, and our loan customers are also people that are depositing with us. So there's this really good symbiotic relationship where they aren't going to pull money out. A loan customer isn't going to pull money out and go and deposit it in another bank. SVB, on the other hand, they had this huge concentration of depositors. But where were their assets? They weren't being lent to those depositors. They were buying bonds. So it was this moving away from kind of a symbiotic relationship that is really intrinsic in a community bank.
Signature Bank. I haven't really read too much about what really caused Signature Bank to go under. I actually have a friend of mine that does some big deals in a big lending institution that has that's their primary bank. So that kind of hit home for him. I know they're fine. They're going to be insured, and he feels comfortable with it. But what was it that caused the trigger for Signature Bank?
It was very similar. My understanding is that they had a lot of crypto deposits, and in those particular cases, they aren't lending to those crypto customers, and those people are all very well connected on social media. And so once kind of that herd mentality starts of like, hey, let's switch banks, let's go to a bigger bank or a community bank or somewhere else that where they can protect our deposits. Then it just that's how that one failed as well. Awesome.
Well, hey, that gives me some sense of security, at least in knowing that not only is Kansas City pretty well insulated, I think globally, if we just kind of, what does my dad always say, level heads will prevail, and so if we just kind of keep our heads, then the financial markets will not collapse. This is not a global crisis.
No, and I really think this is common sense banking. I'll use an example. We had a customer who sold a portion of his business weeks before the SVB failure and made a large deposit in our bank. And proper management dictates that we just keep that in Fed funds. We aren't going to invest that or loan that out because that's in our terms hot money. We don't know when that's going to go. And so the safest thing for us to do is keep that in Fed funds. And so when these banks started failing, that's where that money was in Fed funds, and that's what they should have done.
Smart. Well, hey, this is the end of part one. Tyler, I want to thank you today for coming on the show. I think it'll give my investor base a lot of ease. But if you're interested more in what Tyler does at Bank 21, we're going to go deep in part two of our series here when we talk a little bit more about local banking and how it relates to real estate. Obviously, we have a lot of real estate investors watching the show. We're going to go deep on that in part two, so check it out.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.